profitability has come in more or less in line with what the street was estimating at around 1,060 crores. That's around a 50 crore miss in comparison to what the street was estimating. That's the only number that we have at this point of time. We're waiting for the total income number. Remember, our poll threw up a number of around 8,323 crores approximately.
I've got 7973 for you, Nigel. If I'm trying to rotate the release and read it right, but 7973 is what I seem to be getting. That's a standalone number, so that's a standalone top line. Let me try and fish out consolidated picture as well. But what we have been expecting, so yeah, the consolidated is now out. It's 8,105, which is also slightly shy of expectations. So this is not looking extremely good right now for Lever, at least as of now. I think we've got Suruchi Jain joining in. Suruchi, thanks for taking the call. We're still waiting to get the segmental performance, but your first thoughts looking at top line and bottom line?
I think bottom line is definitely a little shy of what we were expecting. And I don't think I got the top line figure.
8,105.
8105. Yeah.
I think that's broadly in line. We're hoping that, the later part of the year, the growth will pick up. Because what we have is actually a slightly optimistic assumption on revenue growth of 13%. And bottom line growth of like 10%.
All right, we've got the volume growth numbers as well, Suruchi. Let's help you with that. I think it's coming at around 6% is what my director tells me. 6%, is it more or less in line with what you were estimating?
Yes, I think volume growth is in line. What we're expecting is more growth to come from the pricing front.
Okay.
But I think it could take a couple of quarters for the premiumization story in the urban areas to really, pick up.
Okay, Suruchi, let me give you some more details from the press release. The company says the domestic consumer business grew at 5% with 6% underlying volume growth, as we've mentioned. The growth in the quarter was impacted by phasing out of excise duty incentives and price degrowth, as the benefit of lower commodity costs was passed on to consumers. So let's see what that means for margins. The company is saying that they've actually taken price cuts to bump up volumes. Is this balance going to play out all right for the company?
So I think, what we'd spoken about was that in Q1, Q2, Q3, Q4, we actually saw very good margins because of this lower commodity costs.
Right.
But in Q1, Q2, actually, things could reverse because people end up using the higher gross margins to pass on price benefits. And HUL definitely has done that.
All right, Suruchi, I think we have the margin number as well for us. So the top line, going by the top line of around 8105, that's flashing for you on the screen. We have our operating profit that's coming at around 1,506 crores. That would mean the margins of around 18.5%. That's met your expectations. Has it bettered it? Because it looks like it's a tad bit better than what our poll threw up a number of closer towards 18%. So more or less in line to a marginal beat is what it appears. In comparison to our polls. What's your take on it?
So I think that's the EBITDA number that you're talking about.
Yes.
We look more closely at EBIT because, DNA can vary. So we look at we're looking at a 16% for the full year.
All right.
Which by this number, I think it'll be broadly in line.
Correct. All right, let's get in another opinion as well. So she just hold on. We're coming back to you. Naveen Kulkarni joins us currently of PhillipCapital. Naveen, you have the numbers with you. The top line, I'll just run you through. Top line at around 8,105. We have operating profit at closer towards 1,500 crores approximately. Margins would be more than 18%. And the big volume number, in fact, that we're looking out for has come in at around 6%. In line, better, is it worse versus in comparison to your estimates? Could you tell us?
Yeah, the volume numbers are in line with our estimates, so we are expecting 6% volume growth. So that number is in line. Revenue is a tad slower because of the pricing deflation which has happened in this quarter. EBITDA number is pretty much in line, and PAT is a little lower than what we were expecting. So the revenue number is also impacted by the excise duty impact. I think it could be in the range of around 170-180 basis points in this quarter.
Okay, I got a quote from Mr. Harish Manwani just describing the business environment. We will be hearing from the HUL management in just a short while from now. saying we're quite pleased with the stepped up momentum in the personal products business and the sustained double-digit performance in packaged foods. Near-term outlook largely dependent on pickup in the rural market, and commodity costs are expected to remain benign with little or no price growth across select categories. I also have one more number for you, Naveen. The A&P cost, if I'm getting the number right, is 209 crores. That's up 200 basis points. The company is saying overall competitive intensity has remained high across categories, and investment behind brands was sustained at competitive levels. So a 200 bips increase in the overall A&P. How would you read that, and what that will mean for margins in the coming quarters?
See, A&P, typically the benefits of A&P come with a lag, but with the decline in commodity prices and growth primarily to be driven by personal care, step up in A&P was expected. So we believe that A&P might get stepped up even further in the forthcoming quarters. So rather, I'm saying the intensity in advertising and sales promotion when growth has to be driven by personal care, that will sustain.
All right, Naveen as well as Suruchi, just hold on to that thought. We have our in-house expert that joins us, Agam Vakil. Agam, give us your take on the numbers. The stock has recovered close on 2% from the day's low, and also you can put forward the questions to both our analysts.
Right, so I'd just like to point out some of the segments. The key segments here is soaps and detergents, as well as personal products. And the reason why the personal products segment particularly is very important is because while it contributes just about 30% to the overall top line, in terms of EBIT, it contributes to nearly 47%, and we are looking at the EBIT of around 712 crores right now. So, well, if any of the experts are online, I'd like to ask them, is that a number which is which they are looking at, and whether or not that is something which they are fine with the kind of numbers that we see in this particular segment?
712 crores in
personal products.
Personal products, of course, that looks to be an encouraging number, considering we did around 600 crores in Q1 FY15. So 20% growth in personal care EBIT number is quite encouraging.
And how about the revenues that we are looking at in soaps and detergents? And the revenue number there is around a little over 3,850 crores.
Well, that's kind of in line. YOY, it's more or less flattish. So I think the passing on benefits in categories like detergents has happened. So that could be the reason why the revenues are flattish.
So we also had an analyst meet about a month ago where the management had enumerated the plans with respect to the personal products, where they are going to be very aggressive. Based on that, what is your take on advertising spends, and how do you think that can affect margins going forward?
As I charted out earlier also, that personal care is a category which needs very high brand investments, and if growth has to be driven by personal products going ahead. Soaps and detergents are mature categories. They tend to be more driven by pricing rather than volumes. In the current scenario, pricing is hard to come with the commodity deflation. So personal products is where the growth will come, and if the growth as well as the investments will follow through, but I don't think so that's going to impact profitability as such. The approach will be quite calibrated, and they are also resorting to many other avenues of advertising like digital, radio and other means, which are quite, I would say, ROI accretive. So I don't see them impacting margins so much, but growth will still continue to be the most critical factor.
So how would you, let's put it up all together in totality, Naveen, and how would you read this? Now, here's a company which is clearly investing more and now bumping up volume, and that's happening as we've seen this in this quarter at 6%. Where does the stock go from here after the rally that we've already seen, given the fact that they're still guiding for higher advertising spends in order to get the volumes back up?
See, from a stock perspective, we feel that a lot of it is already captured into the price. See, the numbers that we are expecting or we are estimating, they are more or less the company is managing to deliver those numbers in line with the expectations, and the valuations are already captured those high expectations. So we are expecting personal care to deliver, and that's happening. I don't see huge positive surprises coming through from here on. because the pricing-led growth is going to be quite muted. So from that perspective, the chances of being positively surprised and further re-rating from these levels looks a bit
Naveen, very quickly. Okay, I think the management speaking. We'll come back to you for more questions.
Taking your time to